is kind of necessary if you grow a startup using venture capital as a funding format. And then lastly, I'll still quickly touch upon on the unit economics on the kind of high level. It won't be a detailed deep dive to that topic because many of those things are very related to your specific idea or problem. So it doesn't make sense to go through because that varies a lot depending on what you do as a startup. And then we'll do a Q&A in the end of it, hopefully saving enough time for you to ask questions. I'm really looking forward to hear those. And then after that, we'll end the open session and to continue with the startup experience course. And we'll do a task related to these topics. And then in the end, we'll have still team presentations with that group if we will have time. And then I'll wrap up the session, and then we will do another Q&A with the smaller group if there are any new thoughts or new ideas that you want to discuss about. So I thought that I quickly open my background, also because when I was in the similar stage of ending my studies in Aalto, I think this was often very interesting to hear people's kind of paths from being a university student to what they do now. So I studied information networks at Aalto University, graduated as a master a bit over 3 years ago. But already during studies, I was very actively working. So I was working in SRV, which is a construction company, which is quite far from where I am today. Then went to a student exchange to New Zealand, to the totally other side of the world. Maybe that was also a trip to find myself and my own interests more in detail. And then started to looking in how could I work in the kind of entrepreneurial community or startup community or whatever you want to call it in Helsinki. I was lucky enough that Inventure was looking for an analyst, and I joined them for a 3-month kind of internship. And then we extended my kind of work year over year. And after 2.5 years being there, I even got a proper employment contract. So it was a rather more based on trust and well agreement, which I probably wouldn't recommend otherwise. And then from that role, I've now transitioned to one of our portfolio companies that we've invested, a company called Material Exchange. So I'm here on a VP of growth and expansion role, so helping the company to expand on many different fronts. And at the same time, I'm on a secondary from Inventure. So the plan is that I will go back to Inventure by the end of this year. Through Inventure, I've been lucky enough to work with some great startups. The two to maybe mention, one is that a company where I didn't lead the original investment, but I was the chairman of Umbra. You might have even spotted from the news, but Umbra was acquired by Amazon earlier this fall. So that was an exciting journey for the 2 years, seeing the startup fully focused on technology, being acquired by one of the largest companies in the world, and seeing how their M&A process worked. Unfortunately, can't disclose much of that though. And then another one, a company called Swappy, that some of you might know, especially if you are based in Finland or the Nordics. Swappy is selling refurbished iPhones. So they buy broken iPhones from the market, refurbish them themselves to high quality. So they're good as new. And then they'll sell them to consumers through their e-commerce shop. So you can basically buy same level iPhone that you would buy as new, but it's more ecological and cheaper than what you would buy it as a new. That company has been growing like crazy. I don't know how many company awards it won last year, but we also raised 36 million of follow-on funding. And we can't yet reveal how much we did revenue last year, but the growth has been 3x almost all the time. So reaching quite high levels there, and they are actually recruiting. So if you're based in Helsinki, I think that would be a great opportunity for anyone to join and understand more about startups. So that's my kind of personal background. Then I'll jump into what is actually venture capital, because I'm sure not all of you know how it really works. And I've taken quite a, let's say, financial point of view, because I think this is something that you don't often read from the news, and this is not something that first comes to your mind, on how actually the money flow works in a venture capital fund. So how does it work is that we are, as an Inventure or a venture capital fund, we decide to raise, let's say, 100 million from the market. We go to visit LPs, so limited partners, which could be large pension funds, family offices, so wealthy families. It could be EIF, European Investment Fund, which is a kind of large investor in many of the European venture funds in Europe. And we asked from them to commit to a VC fund. And then we start doing investments to startups, let's say Volt, Swappy, or someone else. Whenever we need the money, we will call it in from the LPs, invest it to startup. When the startup gets acquired, like Umbra got acquired by Amazon, we'll get the money back return, hopefully with a high multiple, and then we'll return it to our LPs. And how a venture capital fund makes money is two things. We get a management fee from our LPs, so managing their money. And second is that we get kind of a success fee based on the returns. So if we return the money with a high multiple, we think we get a concept called carry, so carried interest based on our performance. So we, as an Inventure, don't really own the money. Only portion of it comes from our own team. The large portion comes from our own customers, which are the limited partners. So we, as Inventure, have been around quite a while. Founded since 2005, we've done over 60 investments across Nordics and Baltics, raised to more than 500 million to our portfolio companies. Ourselves, we have, on top of that, raised 230 million to our 3 different funds. Actually, we have a team of 12 now in the Nordics. Here are some of the deals that you know, at least Volt, for certainly should be known for everyone in Europe by now, and others you can Google on what they do and what's the background of those companies. And we just read on our branding last week, so nothing in the slides here is updated. They're all with the old brands, but I didn't tell anyone at Inventure, so they didn't know that I'm still presenting with the old logos. Here, quick oversight of the team, just showing what a typical venture capital fund has inside. Most of us working with new investments, but we also have an expanding platform team that then supports our portfolio companies once we've invested to them. We have hired new persons also in HR and communications that then focus on supporting the companies on those matters. We, as a team, want to be very diverse, because that's a big issue in our community, is that we've ended up, due to many reasons, in a community where, for instance, well, let's say white male founders raise a lot more capital than, for instance, females. And also many people working in the financial community have a very similar educational background, similar values, etc. So that's why we do a lot of work when we hire new people, that we actually get people from different kind of backgrounds. And I'm an exception, being a Finn in Finland, but we have, I think we're speaking more than 7 native languages at the moment. Gender split is roughly 50-50. I think it's 40-60 at the moment. Of course, fluctuating a bit who you count in. Also different educational backgrounds, different age diversity. So we're really spending a lot of time building a more diverse team, because we hope that, or we know that that will actually make us better venture capital fund, because we look at startups from different angles and therefore hopefully make better investments. So for instance, we've done a lot of investments in femtech, investing in female healthcare solutions, which for sure we couldn't have done if we wouldn't have such a diverse team that understands that problem more in depth than, for instance, myself. And I think that's one of the strengths that we've managed to keep this team over the years. No need to go through these exact things, but some of the successes that we've had lately, and Volt actually has raised already a lot, or even bigger round after that. But now let's get to the actual topic. So I'll first start with the kind of market potential and then to unit economics. And when we look at startups, these are two very important things when evaluating startups. If you want to hear more about what I mean with team market fit or product market fit, or with deal, let me know and I can in the Q&A open those up more. But we'll be focusing on these two areas today, and scalability is very tightly linked to unit economics. But first, I'll start a bit of the background about market size and why is it important. I ran across this with this Quora question a while back. So my startup's market size is small. Is it a bad thing? And hopefully by end of this session, you'll be able to answer that. First, to understand venture capital. So venture capital is a very risky asset. We invest in very early stage companies, and therefore our investors are expecting very high returns. Because it's a very risky asset, they also are expecting that it's going to be a high return. We know that this is the case, and therefore we know that we have to return our fund with a 3x multiple. So if we raise 100 million fund, we should be able to return the fund, so return 300 million to our investors. Meaning, if a typical life cycle of a fund is 6 years, we do 20% year on year. That's how you roughly end up to this 300 million and 3x. So basically, roughly 20% IRR. To put things in simple terms, of course, there are other things that affect the IRR. So let's say we raised 100 million fund. We invest that to 20 to 100 companies. I would say a typical VC fund invests between 20 to 40 companies. So it's a rare case that they go beyond 40. So in this example, I've split this to 20 investment because that's closer to reality of the VC fund. And when we invest, we know, and you know as well, many startups fail. So statistically, it's impossible to invest in companies that all these 20 are going to be successful cases. So therefore, the returns are slightly skewed. But I'll now show you how skewed they are. So if we put it bluntly, typically 50% of a fund, the startup will fail or return actually no money to investor, meaning that we've lost 20 to 50 million euros to these startups. Of course, we as a fund try to work so that we don't invest we invest as little as possible to the companies that won't go well. But this is not really a problem because we try with all of the startups to reach to the high sky. So we accept that there is a risk that some of them will not return money, but we need to return the money with the rest of the fund. So then typically, let's say the next 5 out of this return 2 times the money back. And if these 2 return the money back, we will roughly, hopefully be in net zero from the 75% of the fund. Meaning that we've lost 20 to 50 million with this, and hopefully return 25 to 40 million with this. It could be that we could be even negative after the 75% of the fund. So it puts a pressure of returning 300 million from the 5 companies left in the portfolio. Or in this case, I've calculated now at 260 million. And in an exit, we typically own 10% of the company, when we invest, we typically own between 50 and 20%. But because that company will raise additional funding rounds, we will dilute, so our ownership will get smaller over time. And at exit, we'll own roughly around 10%. So if we have 5 companies that need to be then worth 2.6 billion in total in order for us to make our money back. And this is the reasons whenever we assess any startup, we have to ensure that that company has the ability to return at least 1 billion out of this 2.6 billion. Otherwise, this math doesn't make sense. So it doesn't make sense to invest in any other companies because we know that one of these has to hit this large scale growth. Like for instance, Volt has did. We were the first institutional investor in Volt, for instance. But then we know that in the same fund where Volt is, there's many of cases that have gone bankrupt. And some of them that have succeeded okay. And then there are other well-performing cases like Volt in the portfolio as well. And that's why you always need to have big market size if you raise funding from venture capital. And venture capital, I would say, is the go-to funding format for startups that are looking for high growth. But it's not for everyone. So there's a lot of other ways to raise funding and finance your startup. And especially nowadays, it's growing and growing. The best one of them is actually customer revenue, which often we maybe overlook, is that you actually get money from your customers early on. And that's how you grow your startup, and maybe delay on when do you actually need to raise external financing. There is private equity funds that we have multiple types of forms that don't require such high growth exits. There's a lot of debt financing. Banks in the Nordics have become also very active in this scene. You have a lot of angel investors that might have very different profiles in what they're looking for. You have crowdfunding, which is not as popular maybe what it was 5 years ago or 10 years ago. Grants, especially in the Nordics, we have very strong grants to get you going. You have donations if you're working for something like a non-profit, and then you go into Bitcoins and et cetera, et cetera. So actually there's plenty of ways to finance your startup. But if you enter the typical VC funding track, then without the large market size, it is difficult to find a venture capital investor. But that doesn't mean that it can be a great business to fund. So later on in the exercise today, if you find that your maybe market size is not very big, that doesn't matter. Then you'll just have to maybe become profitable earlier, or then you have to use other forms of financing to finance your startup. So it doesn't make sense to be dishonest about the market size. So that's on venture capital. I'll maybe continue immediately with the market size estimation and the unit economics, and then we can take questions later. So if you had some questions in mind, maybe write them up, and we'll have them in the end of the open session. All right, now we get to the kind of cool stuff, let's say, on the different market size glossary. So typically divide a market size in these 3 categories. This is maybe even overcomplicating the thing, but it gives, I think, a good understanding of that you're not looking at the wrong market size. So we have the total available market size, which is basically the total market demand for some kind of product. But because your product doesn't really serve everyone in that market, maybe not every single young person in the world would use food delivery. You have a concept called serviceable available market, which is the segment of the total available market that your products and services in your geographical reach you can limit. And then you have serviceable obtainable market, which is a portion again from the serviceable available market, because you will never get 100% of a market. There is not really a monopoly market per se. And now it's a question, is Facebook a monopoly? Well, really not, because we have TikToks and others as well. So you'll always probably have a market share of actually your sum. So you should never assume that you'll get 100% with your market size. So you want that your sum is actually reaching hundreds of millions, hopefully 1 billion, if you want to reach venture capital funding and a kind of that kind of scale. Typically, startups calculate your market size with two different, with one of these two ways. I think if you're part of the course, you already have been come across with these frameworks, but I'll run them through. So top down and bottom up. Top down is the how many toothbrushes you can sell in China example. So you take you find somewhere an estimate of the market size. For instance, how many toothbrushes are sold in China every year. Then you do an estimate on how many of those toothbrushes that you could sell, and that's basically your sum already there. So very simple, typically based on finding a very good precise estimate of the market size, and then just simply calculating down on what could be your share, for instance, in your geography. Whereas bottom up, which I think is in many cases better, because often you are working on a market that's unknown. So you don't really get this good estimate of a market size. If you get this estimate of a market size, probably that market is already invented by someone. So you could even question if there's a very good market study that exactly describes your idea. That is it really innovative and new per se? In some cases, it is still. So this is the easier and quicker maybe way to do it. But when you're inventing something new, you have to often go bottom up. So you have to talk about unit economics and first understand what does one unit mean for you. So your customer profile, how much they're paying, and then you basically scale it forward to reach the sum, so the obtainable market of your business. And often the right way to do this is to actually combine these two. So you'll go a bit top down and bottom up in order to reach a number that will kind of satisfy yourself of what is the right market size. I'll walk that through with an example, which I think describes it better. You don't probably all know Block, but Block is basically a digital real estate agent, to put it very simply. So what they do is they look for apartments digitally, try to take photos of that apartment that is very easy and lean, and then they'll sell your apartment forward. So basically acting as an agent, but in a very, very digital and lean way. So they have a lot lower commission than anyone else in the market. So let's try top down. What would be their market size? And these are not real assumptions, although I might give a rough estimate on what it could be. So global real estate property is worth 200 trillion. No one knows the real number, but that's an estimate I found somewhere. But then because Block only focuses on residential real estate, meaning apartments, we have to only take a portion of that. So that is only worth 162 trillion. Then if we estimate that 5% of these apartments are sold every year, that's actually 8 trillion. And if they get 4% average fee, as typical real estate agent, or let's say high real estate value real estate do, then it's 320 billion. So that is actually their global real estate agency market. Could be already 320 billion, calculating like this, top down. Then let's say that Nordic real estate residential market is actually 750 billion. So quite a small portion of the global one. Again, 5% are probably sold every year. They get a 4% average fee. So it's 1.5 billion their market size. So there's some in Nordic real estate agency market size. But then if we consider that actually their average fee is 0.75, and they only take 60% of the market, not 100%, then we reach actually the number that we should be looking at. So what is their market share could be in the Nordics, which is 168 million. So this is a top-down methodology. You take something small, you slice it, you slice it, you slice it until you get to a number that you think includes all the assumptions needed to your model. But if we go bottom up, we look at first one apartment. So we look at, all right, an average price of an apartment is 200,000. Their margin is 0.75. So we look at their unit, which is one apartment sold. So they get 1,500 per apartment that they sell. If they sell 50,000 apartments per year, which is how many apartments are sold in Finland every year, they get, out of everyone, they get 1,500. That means that in Finland, it's a 75 million euro market. Then we multiply that by 5. So taking from Finland to Nordics, if you multiply by 5, typically it's roughly quite a rough good estimate, because Sweden is twice the size of Finland, and Norway and Denmark are roughly the same. So we do that very rough estimation, and we get to the Nordic market size of 375. And then we take the 60% market share that we were estimating. So then we actually end up to 225 market size for Block. So now what we would do is basically try to look at these two numbers and see which one we kind of believe is more accurate, and how the truth lies somewhere in between. But often this bottom-up approach gives you a smaller number, and also therefore a more accurate one, because it actually looks into first of your assumptions of your unit, instead of looking at the large market data. Then this is a real picture for Airbnb's first investment deck. This is what they had in their market side slide. They had two numbers basically describing the number. Market validation, how many temporary housing sites are there on Couchsurfing, was a kind of key number. And then they showed basically top down how many trips books, how many of those are budget and online, and what they expect that their share of market could be for Airbnb. Probably the market size ended up being even bigger than they probably thought originally, but this is still quite a doesn't really have the rationale behind it. The reason is that they probably have explained this all verbally, and many investors actually didn't invest because they didn't believe that this market existed, because for many it was conceptually something that they couldn't understand, that someone would rent your room from your own home to someone that you don't know. And that's why the rationale behind it, so how do you believe that this number is actually correct, is as important than the number itself. So if you just throw out these slides or throw out these numbers in your exercises or in your investment decks, it doesn't really tell anything, because you can invent the number from everyone. But how you landed that number and what does that number tell you is a lot, or even more important than the number itself. But maybe a second point to find out here is that in the end result is not maybe super complex. You can present it actually with quite a neat, easy way that you. And the more difficult market you're in, the more explanation you have to do. Trying to check the time so I don't go too much over. And then often you're estimating the unknown, as I mentioned. You're trying to think to the future. So if in 1991 you would have tried to estimate, well, what will be the market size of phones or smartphones even, with this device, it would have been probably very difficult to imagine the size of it as it has grown today, which basically all started from this concept, that this concept just evolved to that level that we already spend hours of our time awake just by using smartphones. So it's often difficult to try to estimate the future based on that initial concept. And we're facing at Inventure the same problem every day, thinking about the drone market, thinking about the AR market. Magically, of course, if someone has read the news, it's not going really well during the past years anymore. But it could be that someday, I believe that AR will be the only technology that can replace the smartphone. I think we'll be running with smartphones until we find neat and nice AR glasses, and these are not the ones for sure. And then self-driving cars. We have one investment in that space. That we try to estimate how big that market can be. So we've done, we did a big bet in our 2014 fund to a couple of different themes. One was kind of future of mobility, because we believe that the way we move will change radically over time. And we did 3 very successful investments, right, where Kanatsu Automotive on the future of mobility bracket. So we were really right where the market was heading. I'm not going to go detail on what they do. But then we did another bet on gaming and entertainment going into VR. And it's funny to maybe laugh now and feel that VR was that, how come we even invested in VR? But at the time, it actually looked quite promising. Of course, there was a lot of hype. But if you looked at the technology, it was actually developing super fast. So we were quite bullish that there will be something coming out from VR. However, as we know for now, that totally collapsed. And out of these companies, basically all of them are almost in bankruptcy or in bankruptcy already, simply because the market never picked up as it was supposed to. But as I explained, that's okay for a VC fund to make those errors as long as we make these successes in the same fund. So that's why we can take these bold bets about certain mega trends. That's about estimating the market. Then I'll go into unit economics. So unit economics can be viewed quite differently depending a bit what kind of sources you're using. But basically, the core idea is that you're looking at direct revenues and costs in relation to one unit of your business. And what a unit is varies, of course, for business to business. So in case of Wolt, it's one food delivery. So you're looking at the value of that food delivery, and also over time you're looking at a unit is one customer, and that customer's value versus cost. Or for Zalando, it could be purchasing a shirt, and what are the cost versus revenue of that unit. And there, the ideal ratio of so-called customer lifetime value to customer acquisition cost is 3-to-1 at least. In best cases, it's 5-to-1, or even in some of the super high growth ones, it could be even 10-to-1. Gaming used to have crazy CLV CAC ratios. Nowadays, it's a lot more competitive. So your customer acquisition cost has already raised quite a bit, but they used to have really crazy multiples for this ratio. So it basically comes from 2 different sides. How much is your whole future relationship with a customer? How much will that give you net profit? So it's not even revenue, it's actually the net profit that you're gaining from that customer. And how much, and a customer acquisition cost, how much do you actually have to spend money in order to win and close that customer? I'll walk through some examples so you'll hopefully understand it better. And here's a formula for CLV. Depending on what data you have different formulas for CLV. So you can Google that on finding a CLV formula for your idea. These are again not real numbers, although I'm sitting in the board of Swappy. So I just took them from my head. So let's say in Swappy's case, a unit could be one sold phone. So we get revenue from phone 450. Let's say that's an expensive iPhone. And then we pay for the source where we got the phone, for instance, 300 euros. We buy share parts, we do logistics, we do refurbishment. So actually the customer value for that one order is 115 euros, because this is the net profit basically from the order. And then we spend money on marketing and customer care in order, of course, there are other costs as well, but these are the main ones to get the customer to buy. And that basically give us the customer acquisition cost of 55 euros. Therefore, our gross margin would be in this example, 60 euros. So now if you look at, wait, your kind of customer value times CAC is, in this case, is only basically 1-to-1. So this ratio from 55 to 60 should be the 3-to-1. But then you start thinking about, well, what's actually the customer lifetime value? Because what happens if a customer buys a second phone? Probably we don't have to do this much marketing, right? What if they buy another one for their wife, or they buy 2 phones from immediately when they buy? What happens to this formula then? And what happens if we sell 100,000 phones instead of 1,000? I guess our cost of buying the phones will decrease. I guess we will have more efficient logistics. Our refurbishment can become more efficient as it scales. So actually this entire formula becomes a lot more better when with growth. And that's the important work that all venture capital funds doing, especially in the kind of A, B, and C round investors. Try to estimate that how does this formula work with scale. And if some of you speak Finnish, Miki Kuusi has, I think, a very good Finnish podcast with Talouselämä, where they went through a bit how this works in Volt case, and I think they really well nail it on the Volt case. You can find that on Spotify. So what they're trying to then estimate is what will happen if we kind of 10x this business. So what will happen to marketing? What will happen for customer care? And that's where you do a very deep data dive in trying to understand how the business works. We did that when we invested in Swappy. So did a very deep, and I luckily had external help as well to go through their numbers in details and what we have and where do we estimate that business going and those unit economics working in the future. Here's a case from Uber that I thought would be interesting, as you kind of see that study can be done in multiple different ways, but I really like the way and simplicity of this. So here, Good Work Capital did kind of a calculation on Uber. I'll quickly run it through as well, but I'll share these slides so you can go this through together with your team maybe later more in detail. So let's say in the beginning of a month, there's 69 active riders with Uber. They managed to add 116 riders every month, but 90 stop using the service, which means that in the end of month, 94 are active riders. Average fare value, so how much an average taxi driver costs, is $9. Uber gets 1.95 per ride, because they take rate, so how much they take from the driver is 22%. Yes, and then they get gross profit from that margin. I don't actually know how they calculate it, but then anyway, the profit per ride ends up being $1.08. Probably there's actually some marketing calculated there. And then they give discounts, 1,400. They calculate for discounts, and there they derive at how much they spend on customer acquisition costs from the discounts and advertisement. So basically they get how much they spend money in total in marketing, and then they divide it per riders, and that's where they get to their customer acquisition cost. This means that the rider has to do 18 rides before it becomes profitable for Uber, because they get euro back from every single, roughly euro plus every single ride, and they paid 20 euros to get that customer. It means that the rider has to take 90 rides before it's a profitable customer for Uber. And if you do, an average rider does 5 rides per month, that means that it takes 3.8 months that the customer becomes profitable. And this is what, whenever large tech companies raise money, this is the exact formula type of analysis people do in scale. And if this formula works, so if this is actually correct and all the data and the assumptions are right, 3.8 is actually a very good payback time, because there is a lot of data. You can start trusting that that data is correct, because that's simply happening all over again. So what Wolt, for instance, said well, or Miki said in that one podcast, is that Wolt's user behavior looks almost like a software as a service business, simply because people are, you can so well estimate on how people behave because they have so much data and they're using Wolt so frequently. So it's almost like a recurring business model rather than actually order time. So payback time, a very important concept on the side of customer acquisition and customer lifetime value. So how much time does it take you to recover from the cost of acquiring a user customer? Same thing works in B2B setting and B2C setting. And this is the fundamental reason why these startups manage to raise these hundreds of millions of revenue of money with low revenue, because people see that the unit economics are already working, that if we pour in money here, this will just go 10x, and most likely this ratio could even get better over time. That's my 45 minutes of trying to get you to multiple topics. I'm sure I rushed through some of it. So it'd be great to hear some questions, some comments about the topics that you'll be interested in, and I'm happy to describe more. Maybe if someone someone can help me manage the questions from the team, so I don't have to shout from here, as you probably know better how to do it. Thank you.
All right. First of all, thank you, Lauri.
Thanks.
All right, so now we start taking questions from the chat.
Okay, so we're gonna do it from the chat.
So let's take it from the top. All right, I will start with the more recent questions. So if you feel like I haven't picked up your question, please put it in the chat. All right. First question, where do you find data for making such analysis like you presented in the case of Uber, for example? Is there a data bank or something like that?
In the case of Uber, there you can see it already from the footnote that they have already done quite a lot of assumptions, but you can get some of this data when they went public. And if they're a public company, they're already before a company is public, you start to get different kind of data points. For instance, you start to see how much they spend on different advertisement platforms, etc. But that's the most tricky part, because that data is typically owned by the company only. So if you're looking at the company from the outside, it's very tricky to do that analysis. So there really isn't a perfect data bank that I can direct you to there. But of course, when you invest in a company, then we get all the data about the business. So then we can just ask for it. So that's the benefit of being then in a fund.
All right. Next question from the chat. How do we calculate for the B2B model?
Same thing. Same thing. So you can use the same formula, bottom up and top down. So top down could be that you're looking into first, let's say, what is the software as a service market? Software as a service market globally, that's probably $1 trillion by now. Then you look at, okay, how much of that is, let's say, customer support, if you're doing customer support software. Then you look at, okay, how much of that is maybe in Europe, and then you'll maybe take 60% of that. Or if you do it the bottom up, then you maybe look at first as a unit, you look at, okay, one customer that buys you software. You look at how big of that would be maybe in Finland, and then you scale it to, let's say, Nordics or Europe, because in a software B2B software, it could be Europe as well, and maybe you take a 60% of market share of that. But it's important to first understand your pricing before you can actually do this.
Okay.
Unit economics, we gave an example. Then there was the failure rate. Yes, 90% is probably the failure rate of startups, but we look at roughly 2,000 to 3,000 startups per year and invest in less than 10. So we hopefully do our work well enough to increase the ratio from 10 to 50% success rate. And also we invest in a stage where typically startups already have their first customers. So therefore, our percentage is better. So some of the startups didn't even make it to kind of our stage, as they never maybe found the first customer. So that 90% is often from the beginning. But as you can see, that if we look at let's say 2,000 and invest in 10, the ratio of getting venture capital funding is less than 1%. So it's actually very, very difficult to get there. And it could be that some of those startups were invested by other investors, but anyway, raising venture capital funding is still a rare case. Then there's a question about sum and sum. Let's go back to that. I probably went that quite quickly. So sum is what your service is available, and so it could be available, and obtainable is what you can actually get out of it. So because you never own 100% of the market, that's typically your obtainable. So typically it's the market share what differs these two. And these are not academically agreed terms. So that's why I've seen people using them a bit differently as well. But that's typically the difference. As a fund, how do we estimate companies' market share? I would say that you can use often a typical 60 to 80% as a market share estimate. So we'll never reach 100, but if you really are the winner of that market, probably you'll reach more than 50% if you're in software scalable businesses. If you're something less scalable, let's say you're building a restaurant, it's a lot small. It's probably 1 to 2%. So you have to maybe look at the market and how big companies are in that market, and then you try to estimate on what's the portion that you can actually take out of it. As a fund, do you see different costs in a startup as less risky than others? E.g. heavy marketing cost, heavy tangible asset cost, if they ultimately serve the same purpose, aka growth? It's a bit complex question. Let's put it that way, that we look at the unit economics first, and that gives us the kind of somewhat an answer to the question. If there is heavy marketing costs, that's maybe the thing that kind of is there a bit of a red flag, that are they only piling in marketing money without growing? And if this is the case, I think the unit economics, again, if you do that calculation well, and you give an objective view to it, to your investors, you should be able to actually see how the marketing is actually generating and creating revenue. Then heavy tangible asset costs are typically another bit difficult thing for VCs because of the scalability. So for instance, in Swappy, we have a big factory where we repair the phones. So for some investors, that might be a red flag because they don't want that the startup owns anything that is more pure software per se. But we believe that that will actually increase the quality of the repairs, because instead of relying on some third-party repairs, we actually do high-quality repairs, and therefore our phones are a lot better quality, and we can control the quality of the repairs we do, which no one else can do in the market. So to put it simply, yes, some are more risky than others, but you have to have a reasoning why you're accumulating those costs. Then do you use the same IRR and share of the company figures for every industry? Same goes with EBIT multiple examples. So for us, we invest across industries. So yeah, so we don't really do a kind of, let's say, a deep dive on what's the IRR that we're expecting from a single company, if I'm understanding the question right. But yes, we value different industries, and we see that, okay, this industry has more risk than the other. So we accept that risk. And then EBIT, we don't do EBIT multiple. What we do more often is revenue multiple, because we always almost invest in companies that are not profitable. So their EBIT is always negative. So EBIT multiple won't tell us anything. But what we use is so-called revenue multiple. Revenue multiples for B2B SaaS companies are today between 5x to 10x of the revenue. So if you do 1 million revenue, your valuation is between 5 to 10 million. That assumes you're growing still roughly 2x or more per year. If you Google startup revenue multiples, you'll find multiple sources of that, and there often we use even public examples. How do you calculate for B2B model unit economics? Can you please give some example? Yes, I can. So fundamentally, it's the same thing. It's how much you have spent for marketing and sales. So in B2B, sales is important. So your customer acquisition cost basically includes all the marketing cost, or your communication cost, or your salespeople's salaries, sometimes the customer support as well, all the money you spend on basically maintaining the product. So everything that you actually have to spend to acquire the customer. And then your customer lifetime value is, if they pay, let's say they pay $100 a month, then what you do is you check like this, that they do average revenue per company over 1 month, and then you look at out of churn, so how many customers stopped using the service, and then you divide it with customer acquisition cost. That's how you get it. So you take the revenue that you get per month, and then you multiply it with reversed churn. Then before applying VC funding, we should have paying customers. What are the prerequisites like business plan? We don't, so thinking about the business plan is somewhat, I would say, old-fashioned already. Most VC funds don't want you to write a 10-page plan, but rather that's over a discussion. You learn about the business. The key, let's say, thing is a pitch deck, typically 10 to 30-page deck where you explain what you do, and you have the core metrics, and you describe the story, which is very important, the story about your business. And depending on what stage of venture capital you are, so we are so-called seed to A round investor. We have a bit more things we want you to have in place, as I show here. But if you go for a pre-seed round, which we have, for instance, in Finland, there's a company called Icebreaker does pre-seed investments. They probably are not that interested about unit economics or customer revenue. They can only invest maybe a team and an idea, and that could be enough for them to do an investment. But we would typically like to see that you have already your first customers, or at least are near in signing your first paying customer. So we look at kind of team market fit. So is this a unique team that if we could invest in any team in the market, would this team be it? We look at, is there a product market fit? So does this product satisfy the need of this market? And is there a proof for that? Then there's the market potential, as I explained. Does this business scale? So can we actually scale it to 10 times bigger than what it is today? And is there a proof of the unit economics? And then, of course, we're a financial investor, so we want to know the deal. So how much we're going to invest, what's the valuation of the company, if that's a good fit for us. And then on top of this is basically a match. So can we actually support the business? Can we actually help them forward? Are we a personal match that we feel that they listen to us and they respect us as well? And of course, we respect them. So there is a kind of clearly formation a relationship where we work long term. One way we typically say it is that you work with your relationship with your investor is longer than your marriage, as marriage are getting shorter, and the VC life cycle is also getting longer all the time. Are all companies your portfolio tech companies? In our portfolio, yes. We use the word tech, it's quite broad. So we have, for instance, a vegan cheese company called Noquo Foods in the portfolio. That will be actually, by the way, in the markets probably later this year. So tech is a wide subject, but all of them have, in our case, tech. So we don't invest, for instance, in new media companies or movie IP. We don't invest in those kind of things, as we're a technology investor, and our investment strategy is to invest in tech companies. Any other questions? I think we still have a couple of minutes. There we have one. If there is no existing market, we're creating a new market. How does this model change? It doesn't change. It just makes it more difficult for you, to be honest. So as I explained, this is the work we do every day, trying to estimate something that doesn't exist. And that's the reason why this is so difficult in concepts that are not there. So the only thing you can do is trying to find the rationale of why that market will be big. For instance, there wasn't proper food delivery market reports when we invested in Volt. That was, I think, in 2014. So what you want to look at is you can go into kind of how human behaves in a level. You can say that, well, an average person probably eats 3 times a day. Maybe 1 or 2 out of those meals could be actually ordered through Wolt. then you look at, okay, what's the portions of human beings that could actually afford this kind of service. Then you look at probably it's going to be the old person, it's going to be the younger generation. They have to live in big cities. Well, probably let's take it a notch a bit down. Probably they're not going to eat every day from Bolt. Maybe they do that 2 times a week. Maybe a restaurant order costs 15 euros. Delivery is now 2 euros. So our profit is, let's say, 1 euro per delivery. And through that kind of thinking, you'll find the market size. So you have to use really non-monetary components. So the more innovative the idea, the less data you will find about it. So you'll have to rely more on your assumptions. And when you do your assignments, you have to rationalize on why do you think those are the right assumptions. Is having first customer or knowing unit economics important to get funding? I'm asking this because I have read some of startup story where they got funding just with MVP, like video explaining idea. Yes, you don't need to know having the first customer or having unit economics to get funding, first round of funding, but later on you will definitely need it. So no, you don't, for funding, you don't need those. You can get pre-seed funding. Yes, pre-seed funding you get easily without that, and often even seed funding you can get. So let's put it very straight. So under, let's say over 3 million of funding, you will never get probably without having those, but there are exceptions. Yeah, pre-seed funding is between in Finland or Nordics, it's between 100,000 to, let's say, 500,000, 600,000. 500,000 is probably, and then after that, it's basically seed rounds. Okay, you can even actually call pre-seed maybe 50K. So pre-seed, seed, and these terms are not, they are labels for some amount of money. It doesn't mean much. It's we've invented as a startup ecosystem these stages. Do we have many more? We can take maybe one more question if someone has one, and then we can wrap up this open session. And I think my contact details was here on the last slide, so you can also approach me with if I learn how to use slides one day. Yeah, Lauri at Inventure.fi. So you can also reach me over email, or if you have some questions or some comments or something about this, happy to hear also feedback about this session, because I hope I'll be invited again at some point. So yeah, thank you everyone for listening in. We had almost like 100 people I saw. Accumulating to have so many people listening in. Fantastic to have you all here. Good luck with your studies, and hope we'll come across when the latest when you start fundraising the funding raise for your startup. Then you'll definitely reach out. But hopefully even earlier than that, before when this pandemic is over. Hope to see you face to face somewhere. Thanks.
Thank you, Lauri. And